Hey everybody, Rob Maurer here, and today we are of course talking about Tesla's Q4 earnings report. In the after-hours session today, the market has reacted strongly positively to the report, up almost 12% to $648.50. So we're going to go through all the details here, but first things first, this report to me is about Tesla demonstrating the sustainability of its business. They posted beats on every line that we looked at, revenue by about 6%, earnings per share by about 30%, between GAAP and non-GAAP, both beats, and especially so on free cash flow at $1 billion for the quarter, more than double what Wall Street consensus estimates were. Tesla is now free cash flow positive for the year. They are profitable for the year on a non-GAAP basis, so not quite there yet on a GAAP basis. We'll talk a little bit more about that, but on a non-GAAP basis, profitable for the year. They carry the expectation of profitability going forward, with the exception of some quarters where they may have significant production ramp-ups. And they're ahead of schedule on two major projects with the Model Y and with the Model 3 from Gigafactory Shanghai. Tesla is executing and they are proving the sustainability of their business, and that is why Wall Street continues to react so positively to Tesla news. That being said, I am actually a bit surprised at how positive the reaction has been. The results were relatively in line with bullish expectations, I think. Whereas a quarter like Q3, for example, completely blew away even the most bullish of forecasts. And maybe it's semantics, but to me that makes this look more like a validation move than really a huge surprise type of move. Let's get into the report then beyond just those key metrics, and I want to start with guidance. As I said, that was one of the top things I was looking for coming out of this report. And as I have been cautioning, Tesla was pretty vague in terms of the guidance they gave us. Starting off with next quarter, Q1, Tesla actually didn't give us any explicit guidance for deliveries for the quarter. And conspicuously absent is the sentence that we've been talking about on the last two episodes, which Tesla has given as guidance in the last two quarterly updates, that says that they expect to grow vehicle deliveries sequentially and annually. That sentence is no longer in this report. So in its absence, I think that ends up being actually a form of guidance. And I think Tesla expects deliveries to be down sequentially from the 112,000 delivered in Q4. If not, at least at this point, they're not confident enough to say that they will be up sequentially. Personally, I don't have any problem with that. Tesla last year delivered 63,000 vehicles in Q1, so they have a relatively low comparison this year. So even lacking sequential growth, there should still be strong year-over-year growth with the Q1 report. For really long-term investors, I think the lack of guidance here is a good thing. It shows that Tesla in its communication style is extremely focused on the long term, not super concerned with individual quarter results. And that's good because from a long-term perspective, that's how the business should be run. But for Wall Street, it's a bit of a different game, and this could lead to some volatility throughout the quarter until we actually have those Q1 results. Because Tesla has not given analysts any sort of forecast here to benchmark against, that means they're just sort of left to their own devices, which can really be all over the place. It doesn't create that feeling of safety that investors like. In addition to the lack of guidance, Tesla actually gave a warning on Q1 on the earnings call. This was from Zach, the CFO. He called out 3 different points, all things that we know about and have discussed, but worth noting the mention by Zach. So he called out seasonality for Q1, the fact that 2 major product ramps were going on in Q1 with Gigafactory Shanghai Model 3, as well as Model Y in Fremont. And then third, the impact of coronavirus, which has already caused Tesla to have to shut down Gigafactory Shanghai by an additional 1 to 1.5 weeks, while also noting that coronavirus had the potential to possibly impact Tesla's supply chain, though Zach noted that he did not expect that to be the case. So not necessarily a glowing outlook for Q1, but enough else in the report to offset that lack of guidance. The next piece on guidance that I was looking for was annual guidance, and Tesla did actually give us a little bit of information here. They expect to quote-unquote comfortably exceed 500,000 deliveries for the year. This strategy I really support. They're setting a bar that they know they can beat, then they'll go out there for the year and they will exceed that bar. Wall Street loves this because it sets a floor. The credibility that Tesla has regained, combined with that sort of guidance, means that all you really have to forecast is how far above that bar Tesla will end up. Now, of course, some people will still remain skeptical for their own reasons, demand concerns, macro reasons, whatever the case may be, but the majority will take that number and they'll build up from there. Remember, before the earnings report, the FactSet consensus for 2020 deliveries was 468,000 units. So even at the floor, Tesla should comfortably exceed that estimate. I think that definitely plays a role in the reaction that we saw after hours alongside the next piece of guidance that we were looking for, which was on Model Y. Tesla here was very communicative, giving us more information than I think any of us expected to receive, starting with the fact that the production ramp has already begun and that deliveries will begin this quarter, with the design studio saying they will happen in March. So for those of us that have been paying super close attention, that's about what we expected, as we talked about when we went through the Model Y delivery timeline episode. But I think this was probably a pretty big positive surprise for the street. Not only did we get that information on Model Y, they also announced that they have increased the range on the dual motor all-wheel drive vehicle from 280 miles to 315 miles. Incredibly, this seems to be an entirely efficiency-based gain, as Tesla shared the efficiency metric of 4.1 miles per kilowatt hour, which for a 315-mile range vehicle implies a battery pack of 77 kilowatt hours. So impressive engineering for the Model Y, and exciting in terms of the prospects that this could bring for the other vehicles. In addition to updating the range and timeline, Tesla also adjusted the design studio to have the new wheels for Model Y. So there are new 19-inch, 20, and 21-inch wheels. Tesla also removed the rear-wheel drive single-motor Model Y from the design studio, so we don't know if these efficiency gains would have applied to that configuration or if that configuration will come back at any point in time. But if it were to, and they did apply, we could be looking at a range of maybe 340 miles or so from that trim. These updates for Model Y just put the competition that much further behind Tesla. Not only has the timeline shifted up, the specs have also improved, and competition had their hands plenty full before either of those things had happened. The other thing worth mentioning today on Model Y is Drew and Elon both commenting on how it's more than just a 10% size difference from the Model 3. Of course, we already knew that from a production standpoint, which Elon did again reiterate his excitement there, but they also mentioned that from a customer-facing perspective, it is more than just a 10% difference from a Model 3. This was a bit of a tease because they said they didn't want to discuss those things today. Next piece of guidance I was looking for was on Gigafactory Shanghai, and we didn't get a ton here. They said, quote, "We have been gradually ramping local production of battery packs since late Q4 2019. The rest of the Model 3 manufacturing processes are running as expected. Due to strong initial customer response in China, our goal is to increase Model 3 capacity even further using existing facilities," end quote. So nothing too new on Gigafactory Shanghai unless you want to count that last bit, but I think everybody has been expecting them to continue to increase Model 3 capacity at Gigafactory Shanghai, so good news, but not terribly surprising. Next, I was looking for guidance on Solar Roof and Tesla Energy, and Tesla followed a similar strategy here to what they did for vehicles, sort of setting a floor by saying that, quote, "Both solar and storage deployments should grow at least 50% in 2020, end quote, meaning energy storage deployments should grow to at least 2.5 gigawatt hours in 2020, off of 2019's base of 1.65 gigawatt hours deployed, and solar should grow to 175 megawatts deployed off of 2019's base of 115 megawatts. I like that guidance strategy, and those are obviously strong percent growth numbers, so that should put Tesla Energy at a $2 billion plus business next year, growing quickly. I was also hoping for a specific update on Solar Roof, knowing that Tesla was targeting 1,000 units of production per week of Solar Roof to end 2019. Clearly, Tesla did not get to that rate, so I was hoping we'd get more communication on that today. We did get a little bit, but no hard numbers. Elon just said that they were experiencing exponential growth in demand and output, but also acknowledged that that was from a small base. He said it would be difficult to say a number this year, but demand is strong, and quote, "This will be a major product for Tesla," end quote. The last piece of guidance that I was specifically looking for was on autonomy, based on Elon's tweet saying that full self-driving was coming soon a couple weeks ago. And I would say we got a bit of a mixed update here. He did discuss autonomy quite a bit, but in terms of guidance, he said, quote, "It's looking like we might be feature complete in a few months, but feature complete just means it has some chance of going from your home to work, let's say, with no interventions. It doesn't mean the features are working well. It means it has some, above zero chance. So I think that's looking like maybe it's going to be a couple months from now," end quote. I think we've clearly understood what that feature set would be for a while now, but this is, I would say, the most hedged that Elon has been when he's talked about it, saying that it doesn't necessarily mean the features are working well, just that it has some chance of completing the trip. That's why I say a bit of a mixed update here, but he also talked a lot about the positives, specifically on the foundation that they have in place. He's really happy with that. That's a really good thing, as it seemed like Tesla struggled with that a little bit before Andrej Karpathy came in. But Elon definitely seemed happy with the progress, I'm assuming because of that foundation. A lot of that is behind the scenes right now, but Elon said, quote, "The apparent progress as seen by consumers will seem to be extremely rapid," end quote, due to those building blocks that they've already laid here. The example that he gave, which I think will go underappreciated, but the biggest thing he said was that moving to video training, specifically video labeling with the video on all 8 cameras simultaneously, and this being a roughly 1,000 times improvement on labeling efficiency for the neural net. He said it would be 3 orders of magnitude. That's 10, 100, 1,000. To me, it sounded like that was in the process of happening. He said, we're making great progress on that, but to me it was unclear if he was talking about autonomy in general or the idea of video labeling. Either way, again, a very exciting piece of the foundation that they are putting in place. Even if we don't necessarily get full self-driving feature complete as some of us imagine it this year, the closer and closer that we get to that and the more and more features that get added, the take rate will continue to improve on that full self-driving option, and that can add significant margin that Tesla can then either pocket or use to lower the cost on their vehicle and expand the market. They mentioned a few times, including in the shareholder letter, the growing impact that software will have on their financials going forward, and this is obviously the biggest piece of that. Those were the 6 subcategories I was looking for guidance on. The next update I was watching for was on gross margin. Despite consensus expectations for gross margin to fall by about a percentage point from Q3 to Q4, Tesla was actually able to increase automotive gross margin, excluding regulatory credits, from 20.8% in Q3 to 20.9% in Q4. About a 10 basis point increase, but well ahead of expectations. On the GAAP gross margin line, so including regulatory credits, Tesla's gross margin did fall slightly from 22.8% in Q3 to 22.5% in Q4, but again, just due to those regulatory credits. I was happy to see the improvement quarter over quarter, but my personal expectations were actually a bit higher, given the increase in total deliveries that we had quarter over quarter, and especially so because of the increase in Model S and Model X. Either way, it looked like that was plenty for Wall Street. Another note here that Zach made is that Model 3 ASP, average selling price, has stabilized and actually increased slightly in Q4. And my guess is that was based on Tesla optimizing some of the pricing throughout the quarter. Next on my list of curiosities was operating leverage. This was one of the biggest themes throughout the entirety of the earnings call. Tesla clearly learned so much from the Model 3 the last couple of years. Now they get to leverage those learnings for Model Y, for Gigafactory Shanghai, for Gigafactory Berlin. They highlighted this in one of their opening statements on the shareholder letter, saying, quote, higher volumes driven by Model Y and Gigafactory Shanghai, continued improvements in operating leverage, and further cost efficiencies should allow Tesla to ultimately reach an industry-leading operating margin, end quote. This is extremely important because those operating expenses like maintaining your stores, your staff, things like that, all of that eats into the gross profit of each vehicle sold. So the higher those expenses are, the less profitable you can be as a company. But conversely, if you're able to grow revenue more quickly than you grow operating expenses, more of that falls to the bottom line, the more profitable you are, and the higher valuation you can get. So this is a huge factor in Tesla's eventual ability and somewhat current ability to completely outclass the other automakers in terms of market cap. That's where software really excels because you don't need all of that additional infrastructure to capture additional revenue and profit. And that's what causes the severe difference between a tech valuation and an automotive valuation. Even setting software aside though, Tesla, as they scale, has been able to create more of that operating leverage. So I always keep a close eye on that, and specifically looking at SG&A, which is your selling, general, and administrative costs. Last quarter in Q3, that was 9.5% of Tesla's revenue. This quarter, the same thing. Normally you want to see that sort of progress over time, and Tesla has done that for sure. But even keeping it in line this quarter was impressive, as Zach on the call mentioned that their operating expenses did increase a bit this quarter with the impact from Gigafactory Shanghai and from the Model Y project. So obviously neither of those things are bringing in revenue yet, but as they do start to generate revenue, SG&A, for example, as a percent of sales, will continue to decline. That's the leverage, and that's how you become profitable. Again, a huge focus throughout the entirety of the call. This is definitely a priority for Tesla and for Elon Musk and for Zach Kirkhorn. Next on my list was a long-term update that Elon had referred to in a tweet exchange with Clean Technica, saying that on the Q4 call, he would talk about some ideas for 3 to 4 years from now. We did get some long-term conversation, but I don't think it was what Elon was referring to in that tweet, unfortunately. And in addition to that, my question on say.com, which was supposed to elicit some of that longer-term conversation, missed the cut by 1 slot, ironically in favor of a question asking for more retail investor questions. But Elon did get asked something similar by one of the analysts on the call, thankfully. Not exactly the same, but it did allow him to reiterate his expectation of continuing to grow in excess of 50% per year. That's an average rate, so any individual year could vary significantly. But just for context, 50% growth on 2019's numbers would imply 551,000 deliveries in 2020. which is more in line with my expectations for the year, probably even above that. But when you start to look further out, that compounding really adds up, as you can see on the YouTube version here. In 2025, 50% annual growth from 2019 to 2025 would imply vehicle deliveries in 2025 above 4 million units. Taking things 5 years further, continuing that 50% compound annual growth rate, 2030 deliveries would be just below 32 million in a year. Now, I'm sure that sounds crazy, and it is crazy, but just as a thought experiment and for some context, we've heard Elon on the last 2 earnings calls talk about battery production somewhere in the realm of 2 terawatt hours per year. If we assume a vehicle pack size on average of 60 kilowatt hours, that would be enough battery capacity for 33 million vehicles per year. Maybe not so crazy after all. Of course, that wouldn't leave Tesla with any supply for Tesla Energy, which should be a pretty big business in terms of battery capacity at that point in time. But the point is that this is the type of scale that Tesla is thinking about and starting to plan for right now. It's also worth noting that as aggressive as those numbers seem, that's a 50% compound annual growth rate. Elon said he expects them to exceed 50%. We don't know how many years he means that for, but still important. This is going to be a huge part of Battery Day, how Tesla can get there. Last on my list of things I was watching for specifically, and then we'll get to some other points, was wildcards. And this one's pretty quick because we didn't get a whole lot of information here. The first wildcard was regulatory credits. These ended up being $133 million for Tesla in Q4. That, from a dollar perspective, was in line with Q3, but revenues overall were higher in Q4, so as a percent of revenue, it was actually smaller. So it's not like this was some outlier positive factor for the quarter by any means. The next wildcard was any revenue recognition from full self-driving expansion. This was not mentioned at all in the letter or in the call to my recollection, so likely a non-factor for the quarter. Next was foreign exchange. Similar thing here, so we'll probably have to wait for the 10Q to figure out that impact, but since it was not specifically mentioned, probably not a huge factor. And then the last wildcard here was deferred tax loss, which could have boosted Tesla's profitability. That was not booked, so we'll talk more about that for 2020. Next, I wanted to briefly touch on some financials that we haven't already hit. This quarter, Tesla delivered record free cash flow, record revenue, and an all-time high cash balance at the end of the quarter above $6 billion. So that's the best Tesla's balance sheet has ever looked. That reduces any risk of bankruptcy and allows Tesla the opportunity to start funding expansion with cash flow. Tesla has said they believe they can do that, and yet we still got a couple questions on the call about why Tesla's not raising capital at these share prices. One analyst even asked why Tesla wouldn't raise capital to pay down their debt. So I actually wanted to spend a minute talking about that, because this is an underappreciated subject whenever Tesla's financials are brought up and Tesla's profitability is brought up. Tesla's interest expense for the year for 2019 was $685 million. Tesla's net income, so their profitability for the entire year, was negative $862 million. That means about 80% of that lack of profit was because of interest expense alone. If in the past Tesla had followed this analyst's advice, they could have raised capital and eliminated that debt, eliminated that interest expense for the year, and been pretty darn close to being profitable for the year. The reason that's inadvisable is because selling equity to raise that capital causes dilution, meaning each share gets a little bit less of the future profits, lowering the return on investment of owning the equity. Tesla's debt only cost them, 4 to 6%. I can't exactly remember the rates right now, but it's a low carrying cost, especially compared to equity that you think is going to grow 10 times its value over the course of 5 to 10 years. A 5% interest rate takes about 15 years just to double. So if you believe in the future of Tesla and you believe the equity has more value in the future, it doesn't make any sense to sell that equity in favor of paying off debt now, unless you literally can't afford to pay the debt, which clearly Tesla is doing just fine. That is why Elon laughed at that ridiculous question. Now, some of their debt is convertible debt, so it's likely that some of it will have to be paid off with equity, but the rest will be paid off with cash flow or be refinanced with new debt. Next, I want to hit on some product lines that we haven't discussed yet, and then we'll wrap up with some final thoughts. But first, let's talk about the Cybertruck. So Elon said demand for the Cybertruck has been incredible and that he's never seen anything like it, which is really saying something considering people were literally waiting in lines outside stores for a yet-to-be-unveiled Model 3 just a few years ago. So I'm not sure exactly what to make of that. The last update that we got on Cybertruck reservations was 250,000, a week or maybe a little bit more than a week after the unveiling. And that number was actually a little bit below Model 3 reservations at a similar point in time after unveiling. And the Model 3 was $1,000 down versus $100. So reservations could have spiked since that period of time, especially with how viral the Cybertruck has been, but I'm not putting high enough odds on that to overly read into this comment, other than the fact that they are obviously very happy with the response to Cybertruck. In addition to teasing, quote, "the product is better than people realize," end quote, Elon said, quote, "demand is far more than we could reasonably make in, 3 to 4 years, something like that," end quote. When pressed on any of those production numbers, he didn't give us any information, saying that it all came down to battery supply. Again, a constant theme throughout. That brings us into the next product, the Tesla Semi. Elon said, similar situation here. Cell constraints were the reason that the Semi has not come online faster. But Tesla did reiterate in the shareholder letter, quote, "we are planning to produce limited volumes of Tesla Semi this year," end quote. Next up is Model S. Small update here. Elon said that it won't be long before they have a 400-mile range Model S, and that the range for the Model S on the website is actually higher than stated. So right now it's at 373 miles, but Elon said they just need to do the EPA process again, and it should come up to the 380s range. I would assume similar logic applies to the Model X as well, but it was not specifically mentioned. And then presumably on both these vehicles, Elon did give us a bit of a teaser on the Plaid Powertrain, saying, quote, "the Plaid Powertrain is like mind-blowing, I think. Yeah. Coming out later this year, end of the year probably. That's our goal. Get the Plaid Powertrain out end of the year." And then it's going to be like, this is like alien technology. It's insane. I didn't even think we could do it. Honestly, I thought there's no way. This kick-ass engineering team, Tesla's all about hardcore engineering, end quote. That is something you do not see very often, if ever. Elon Musk thought they couldn't do it, and then they actually did it. Man, I can't think of any better reason to be excited about an upcoming technology. That being said, it looks like the timeline is pushed back slightly here. Elon had originally tweeted that the Model S Plaid variant would go into production around October-November of 2020. But then in October of 2019, he updated that by saying, quote, "the final configuration used at Nürburgring to set the record will go into production around summer 2020. So this is not merely for the track," end quote. So it looks like we move that back again to the end of the year, which might put some pressure on Model S and X sales this year, as that may impact the top of the line, but people may also expect some of that powertrain development to trickle down through the lower trim vehicles as well. Next on the product list is Tesla Insurance. So put simply, the goal for Tesla Insurance is to leverage the data that Tesla has to lower the total cost of ownership of Tesla vehicles. Paraphrasing Elon, he said, they have a fundamental information advantage that insurance companies simply do not have. Elon said, quote, "insurance is going to be, I think, quite a major product for Tesla over time," end quote. And also discussed that it will be relevant for the Tesla network in the future, and that even before then, Tesla would like to leverage their data to lower insurance rates for people using autopilot more frequently, since Tesla views that as safer. The last quote-unquote product line that I wanted to talk about here is batteries. There was a lot of holding back of information because we have Battery Powertrain Day coming up, Elon said likely in April. As I mentioned, the idea here is to tell the story, as Elon put it, of, quote, "how do you get from here to a couple thousand gigawatt hours," end quote, which would be 2 terawatt hours. Obviously, this involves Maxwell, as we've talked about. Elon said, quote, "I think it's going to actually blow people's minds. It blows my mind, and I know it," end quote. At one point in the call, Elon thought aloud, saying, quote, "man, do we know a lot about batteries. Geez," end quote. He also gave credit to Panasonic, even though there have been some rumors of tension in that relationship. He said they have been a, quote, "excellent partner," end quote. So nice to see that, and so much to be excited about. For batteries, as Elon said, this and autonomy should be the 2 major focuses for investors. All right, so let's wrap this up nicely with some final takeaways. Elon, I think, was confident. He was excited. Tesla has finally learned to underpromise and overdeliver, and Wall Street loves it. Tesla is executing. That's a huge reason for the stock price appreciation that we've seen. They acknowledged this in their opening, saying, quote, "our pace of execution has also improved significantly as we have incorporated many learnings from our experience launching Model 3, end quote. The combination of these things has put Gigafactory Shanghai ahead of schedule, and it has put Model Y ahead of schedule. Huge things for the stock. Tesla's fundamentals continue to be strong, free cash flow positive for the year, non-GAAP profitable for the year, and a profitable outlook going forward into 2020. Which, by the way, on S&P 500 inclusion, I should have mentioned this earlier, but the requirement would be $151 million of GAAP net income in Q1 to be profitable over the trailing 12 months for S&P 500 inclusion. Pending some of the wildcards, I think that's going to be pretty tough, so I'd expect more the Q2 timeline, or post Q2 rather. But either way, that leads nicely into the last takeaway, which is the long-term vision is extremely well intact. As Elon said on the call, quote, "Where will we be in 10 years? Very exciting to consider the prospect," end quote. That is it for today. Don't forget to share, don't forget to subscribe, and I will see you next time for the Thursday, January 30th episode of Tesla Daily. Thank you.